we'll get started. So I'll give you sort of a brief introduction of this particular presentation. We do 12 presentations a year, lots of different ones. We're doing one that is a two-parter, 2 hours long, about the impact of artificial intelligence on data centers and data center investing, and where those data centers would be and what the opportunities are and what sort of data center companies can you invest in. They're usually not companies that are building data centers, but there's lots of interesting companies that benefit from data centers. So we have a two-parter presentation that's coming up. We just did one on Airbnb, which was an hour long. All of these are stored at that logo that you see on the bottom left of the screen, Multifamily University. So if you Google that, you'll see the Airbnb presentation there. In a few months, you'll see the AI presentation. The real estate trends presentation is one that we do in end of January, beginning of February. It's the one that we spend the most amount of time on, most amount of effort on. And that one, we basically talk about all the big trends of the year, and then we do 6 different best city presentations from third parties, other folks, and then we at the end pick our best cities of the year. So I picked Las Vegas and Indianapolis as the best cities to invest in. So check out Real Estate Trends. It's free. It's at Multifamily University. Very fun, very interesting. Now, the presentation that you're here to watch is called Location Magic, also called How to Find the Hottest Real Estate Markets. Either way, this is the presentation that's been running the longest. And I've been formally running this presentation for 12 years, but I started developing this in 2009. So I'm a technologist, computer science graduate. Data science is my background. Ran a technology company from 1999 to 2013, so 14 years, not a startup, hundreds of employees. And as we were growing that company, I had the big fat tax salary. I live in California, so I was paying, 40, 50% of my income in taxes. So got into real estate basically for tax savings. Spent a great deal of time, buying single family homes starting 2008. So great timing. Also built a lot of assets, mostly office type assets for my company. We were not renting from somebody else. We basically would build our own campuses. The first one I think I built was in 2003, and then 6 others were built before our company was sold a decade later. So got into construction basically, for my company. No investors, it was just company cash, no loan, just all cash to build campuses. And then with single family, started doing that in 2008, 2009. I'm a data scientist, so in 2008, when I got really interested in real estate, I had quite a bit of money that I needed to deploy, and a question came up which seemed to make all the sense in the world. And the question was, well, where in the United States should I be buying? And while most people prefer to buy, near where they live, so if I live in the San Francisco Bay Area, I'd probably buy something in the outlying suburbs. I wasn't happy with that answer because as a data scientist, you don't usually accept those kind of answers. So it's a big country. And the question I asked was, what's the best place in America to invest in? What makes a place the best or the worst? And how often does that place change? Is there a best place every month, a best place every year, a best place every 5 years? How often do these things change? And I think those are natural questions. But as I would go out and post on forums and look at, software, I couldn't find any good answers, to be honest. Even today, things are much better. There's good software available. But even today, the answer is not really clear. And so I said, okay, well, why I'm a data scientist, let's gather some information. So I paid some Ukrainian hackers to spider the Bureau of Labor Statistics website, bls.gov. We also paid them to, spider Zillow and Trulia and Redfin and, Realtor.com and a whole bunch of other real estate websites. So the real estate website had data about, single family homes and their prices. And then the Bureau of Labor Statistic information was about jobs and incomes and those sorts of demographic numbers, right? Bureau of Labor Statistics, ethnicity, those kinds of things, age. So we were able to basically take demographics information and real estate information, put them into an engine. There's a statistical analysis software called R, just the word R, which is known to all data scientists. And so we would stick this stuff in there and look for correlations. So data scientists try to figure out how the world works by correlating it. So what we say is, okay, how correlated is income to home price growth? How correlated is home price growth to crime? How correlated are schools? And a correlation of 1 is a perfect correlation. So your goal is to find correlations between 2 things that are 1. right? 0.9 is pretty good. 0.1 is pretty bad. 0.5 is okay. So you're looking for really, really strong correlations. So the correlations I wanted to build, and I'm getting geeky for a moment here, was what are the things that most strongly correlate to real estate profits? When I started out in 2009, it was all about single family real estate. These days, of course, it's about multifamily. We own thousands of units, and so we don't really buy single family. But the goal was the same. Like if you're buying real estate, what correlates to it the most? And how do cities fit into that? And so for the first time in 2009, we basically stuck information in, wrote an algorithm, and found correlations. And that formula or algorithm started to develop. I started teaching it at meetups in the San Francisco Bay Area. I think probably taught it in 2009 for the first time. I had 4 people in my meetup, and the meetup lasted until midnight because those people actually happened to be data scientists. And I'd given it a terrible name like the data science or analytics or some weird name. I didn't know the marketing stuff. And so 4 people showed up and they loved it. And we basically had a long conversation until midnight. And I told them the markets that I'm investing in, the correlation and the potential profits in 2009, January 2009, were highest in a market called Madera, California. So back then, I had about 200 markets. Now we look at 323 MSAs or metros in the US. There's 1,016 cities in the US within 323 metros, and we look at all of those. And back then, the city that seemed to be the most correlated to profits was Madera, California. And the correlation, the factor for correlation changes. So today it's supply. The supply of incoming multifamily is the biggest factor that affects prices. Back then, it was price from peak to trough. Back then, that was the key factor. So price in peak, as you can imagine, was 2005, or in some metros, it was 2006. And I was buying in 2009. So that was not quite the trough, but that's what I knew back then. So I started measuring the difference for every metro. What was the peak? What was the trough? Because what I came to realize is that when prices go up, they go up too much. When they come down, they come down too much. And so I was looking for the market that had the biggest drop. And the market with the biggest drop was Madera, California. So it had dropped 69% from its peak. So a home that was $250,000 was now available for 90 grand, right? And so I went into that market and I asked all the builders and I said, what is this home, this brand new home that's available for 90 grand? What does it cost to build? And they said about 180,000. So I said, so if it costs 180,000 to build, how can it be selling for 90,000? They said supply and demand. There's, in Madera, California, Kaufman and Broad built 5,000 brand new homes and signed up all these farm workers from Mexico and told them that they could basically get loans on stated income, fake income. And so 5,000 people signed up and bought these homes. And now that these homes are, have no value, those people have all left. So there's a portion of the city that's empty with brand new homes. And so supply and demand is an issue. And so I said, but these homes are beautiful. They're brand new. They're all 4-bedroom. They look like gorgeous homes. They must have value. And he said, yeah, there would be great value if you could find renters for them. But all the jobs are in Fresno, and Fresno is 22 minutes away. So I said, okay. I went to Fresno. I bought in back then it was a 1984 built home. So I'm doing this in 2009. So I go buy this home and I go back to my Ukrainian hacker and I say, I need 1,000 renter leads on this one old property. And he says, why would you need 1,000 leads? You probably need 10 and then it'll be rented. I said, no, I need 1,000 leads. Just spend as much money as you need to. And so he started spending money and the phone started ringing off the hook. So I hired a Filipino lady to process all of the leads. And when the leads would come in, she would basically get on the phone with them and say, well, that property in Fresno is rented, but 22 miles away in Madera, we have these 10 brand new properties. Would you like to rent any of them? The rent is only 60% of the Fresno rent. You have an extra bedroom and they're brand new. And if you just go there for an open house, we will give you a $50 Amazon gift card. Most people would hang up on her thinking, some kind of scam. But every 10th person, every 20th person would be like, okay, this is interesting. These are very beautiful homes. Let's go look. So they would go there. I wouldn't buy the homes. I would basically tell the broker that I was trying to first, get some rents. And so people would go there, they'd sign a lease, and then the next day I would walk in with cash and buy the home for $90,000. Those homes are now all $400,000 each. And all of that knowledge came in by picking a city, using the methodology that you're about to see, only it's gotten better over time. So we call this location magic. And now we'll get started with our presentation now that you know my story. So since then, I've done a lot in real estate. So 2013, sold my company, had a huge tax day, went into multifamily to get away from taxes, and ended up being a full-time real estate guy. I actually retired for about 6 months, hated retirement, really boring. Injured my shoulder because I would play too much golf. And I haven't been able to play golf ever since. Um, and so went back into real estate. The portfolio is actually smaller now than it says on the screen, 947 million, because we've sold a massive portion of it in 2022 when things were good. It's about 660 million, about 4,000 units, multifamily, student housing, built to rent, townhomes, those kinds of things. There's about 5,000 of you, actually last year, about 10,000 that attended our multifamily webinar series, the various webinars that I just talked about. Here's a look at some of our properties. So we've sold 9 of these properties. Pretty much everything on this page has been sold. Let me just check. Yep. Every one of these properties has been sold, all at profit. And then we have new construction assets. This slide definitely needs to be updated because it's showing renderings, but every asset on this page, except for this one, you see this one here, except for this one, they're all built. And pretty much all of them are leased up. Like this one is on sale for $34.5 million. So it's already built. So for some reason, they didn't update these renderings, but these are all beautiful projects that have all been built. Good returns. So the last 4 exits that we had, we basically made our investors 49.8 million. Now, just to be honest, I don't think the next 4 will do anywhere close to 49.8 million, probably average around 20%. But that's because right now is actually a very challenging time to sell. But all of these buildings, and some of these are very large buildings. So, you can see 20 units, 151 units, and we actually added 29 to this one. So these are big buildings. But a bunch of these were actually purchased using the same methodology that I'm about to show you. So investors really like what we do. We're, according to Sarah, we're a breath of fresh air. She's invested with lots of different syndications, like 15 or 20 of them, and she likes what we do because she likes the data-driven approach that we use. So before I get started with showing you the location magic methodology, just remember, we're not investment advisors, and this seminar is provided for educational purposes only. Any investment involves risk, so be aware of your risk tolerance level and your financial situation at all times. We're going to make some recommendations today, mostly around cities, but feel free to accept or reject all of these investment recommendations that we've made. Everything subject to market risk. And a recommendation is definitely not a guarantee for successful performance of any kind of investment. And do not invest your money on our recommendation alone. Do consult professional advisors. All right, housekeeping, a recording will get sent out to you in case you can't finish. Probably will be sent out probably day after tomorrow. All right, so I always like to start Location Magic with this one chart that's super interesting, right? So it's almost impossible for Americans to afford a home now if they're in the mid-market. So I call this the middle America, 18 million families. Right here, do you see this is August 2012? So this is about 12 years ago. The median income needed to buy a home was 51,000. And it was actually still pretty decent until August 2020. So this is about 4.5 years ago, right? So just when COVID started, you needed 74K in income. Now watch what happens since COVID. Today, or August 2023, you need about 114K. That number in 2025 is still around that number. But why? Because what's really happened is that interest rates have come down just a tiny little bit. So you need right now it's about 116, right? So this is not fully updated. But the incomes of those 8 to 18 million families is about 75,000, right? So maybe husband works at Starbucks and the wife is working at Walmart. Well, those people have 75K in common income. Well, but their income needs to be $116,000 for them to buy a home. So what's happening is, as people are sort of getting older in America and getting into their 30s or 40s, none of them are able to buy homes. And this is why, it makes humongous sense, massive amount of sense to be a landlord today. You don't necessarily have to invest with us. It just makes sense for you to be a landlord by yourself, right? So I mentioned that median income, the US average needed today was 115. I mentioned 116 because that's a newer number. But even cheap markets, affordable markets are above that number now. Phoenix is at 121,000. The most expensive market in the US requires a median income of $404,000. So it actually makes sense for us to look at renting, or sorry, being a landlord. But where should we look? You go to a party, or maybe you're in the office and there's a water cooler conversation, and person one is saying Grand Rapids, Michigan is a great place to invest in. Person two is saying, no, it's in Madera, California. Person three says Stockton, California. And you're like, how do I tell the difference? Why? How can somebody just give me something that takes 10 minutes or less, 10 minutes or less to compare two cities, or 30 minutes to compare 4 or 5 cities? And it's very objective, it's very specific, and tells me which cities are better and which cities are worse. Well, that's what you're about to learn. I've come up with 5, I call them real focuses. A real focus is a number. And that number changes every year. I'm going to give you the number for 2025. And this number every year, you can come back to this presentation or go to our website and grab the number. The Excel spreadsheet that comes with this course is updated every year. There's no cost to it. There's no subscription. There's no higher tier. It's just free. It's yours. You just grab it forever every year. So the spreadsheet for each city has 5 numbers. We call them real focuses. The first real focus is population growth. You're looking for cities that have this number, 9.1 population growth, 9.1% population growth. If your city is between this number of people, 250,000 people and 1 million people, which is most cities in the US are that you would want to invest in, are in that number, right? Then you want 9.1% population growth between this year, 2013, and this year, 2022. And yes, I realize we're in 2025, and this number says 2022. Here's what I found. If you want to pay money, there's lots of places where you can find this number for 2024. Obviously, we're still in 2025, so you don't have that number for 25 yet. For 2024, there's lots of paid software that you can find. 2 that I like to recommend to people: localmarketmonitor.com, localmarketmonitor.com. And also, I like to recommend Housing Alerts, housingalerts.com or housingalerts.net. Feel free, pay $2,000, you'll get access to the population data. Very useful. Here's what I find though. Whether I use the public data, and I'm going to show you where to get the free public data, or the housing alerts, cities don't change over years, they change over decades. So when I use the free data, which is available until 2022, so usually 2 years out, I end up with the same list of cities. The city list doesn't change much unless something dramatic happens in a city, like Amazon opens a corporate headquarters in a city, or something weird happens, oil is found all of a sudden in a city. Other than that, the city list is the same. So I recommend you don't waste any money and basically look at this much, 9.1% population growth between this year and that year, right? Or pay more for local market monitoring. So, So there's these are the numbers, 2013 to 2022. Now for large cities, right? So you've got a city that is bigger than 1 million, all the way up to Phoenix, 5 million people, Atlanta, 5 million people. Then the 9.1% number is not going to work for you. It's too much. Bigger cities grow slower, right? Smaller cities grow faster. So then you want 6%. And what about micro cities? What if a city is less than 250,000 people, like Idaho Falls or St. George or Grand Rapids, Michigan, right? In that case, you need faster growth. Why? Because you're taking a bigger risk. Anytime you invest in a smaller city, you're taking a bigger risk. Well, then you need to be compensated for that risk. Well, then you need to go to a city that has even faster growth because there's lots of them, because you are taking that risk. So the main number, and this is the number that you'll use most of the time, cities between 250,000 and 1 million people, is 9.1% between these 2 years. These are ultra large cities, 6%, micro cities, 13%. It's very important to understand that this number that I gave you, 9.1%, it only applies to this year, 2025. Come back in 2026, get the Excel spreadsheet, it'll probably be somewhere around 9.8 or 9.9 a year from now, right? So don't use this number anytime except for 2025. Now, I'm going to tell you where you get the number from. It's very straightforward. We're going to go drag this over, and I'm going to go to a website. It's city-data.com. Please note, this is not city data, it's city-data.com. I'm going to plug in a city called Columbus, Ohio. Not a particularly sexy city, but one that actually works really well for my examples. So you'll see a lot of ads that, funny enough, this is a property that I own. It must know that, so it's showing it to me. But Falls at Brisbane Commons is a property that we built, 240 units. That's just an ad. All right. So when you go down a little bit, you're going to notice population in 2022, and it's going to say, here's the population growth in Columbus in 2022. You can be plugging in any city in here. So maybe you're plugging in Grand Rapids, Michigan, or some city next to your house.